DVLT filed a headline that sounds massive, a potential $2 billion financing. But when you read the filing, the story changes. It is not simple cash. It is not fully binding, and the company may owe a $25 million non-refundable payment before investors ever see the full benefit. So today, we are not asking whether the headline is big. We are asking whether the headline becomes shareholder value. This is not financial advice. I am not telling you to buy or sell DVLT. This video is about how to read the filings and separate proof from possibility. A DVLT is trying to do something massive, but the financial statements are almost daring investors to prove it. The company is announcing hundreds of millions in potential fees, while the latest quarter shows only $111,000 of gross profit. So the question is not whether the story is exciting. The question is whether the story is outrunning the balance sheet. That is the whole DVLT debate in 1 minute. The bull case says this company is assembling a data asset platform before the market understands how all the pieces fit together. The bear case says this company is announcing a lot more than the financial statements have proved. Both sides have something real to point at. So we need a proof ladder. Every time DVLT announces something, score it on the same ladder: announcement, binding contract, recognized revenue, collected cash, gross margin, per share value. Green means proved, yellow means possible, red means still missing. By the end, I want you to understand 3 things. What the $2 billion filing actually says. What Datavault AI is trying to build if the financing is not cash yet. And what future evidence would make DVLT look less like an announcement stock and more like a business. Start with the filing, because that is what the title promises. The company announced a potential $2 billion structured financing term sheet on June 1st. Then on June 4th, it filed an 8K. The 8K is the important source because it separates the headline from the legal mechanics. The filing says Datavault entered into a non-binding term sheet with HELMEX Global LLP relating to a potential $2 billion structured financing transaction with HELMEX Financial LLP, HELMEX Global LLP, or their affiliates. The transaction is expected to operate through an institutional investment fund and to be structured across 4 possible tranches of up to $500 million each. The filing also says Datavault has a binding obligation to make a non-refundable payment of $25 million no later than June 4th, 2026. That payment is for administrative, operational, and structuring-related costs and expenses for the first tranche. The term sheet also contemplates an additional $25 million fee for each additional tranche. This is why the $2 billion number is dangerous. It is large enough to attract attention, but it is complicated enough that investors have to read the mechanics. A normal cash raise is simple. Company sells shares, cash comes in. This is different. The filing talks about preferred units, tranches, approvals, valuation, possible share issuance, and control rights. So the investor question is not, is the headline big? The investor question is, what usable capital actually reaches Datavault, and what does the company give up to get it? The proposed transaction may involve Datavault issuing shares at $1.55 to $2 per share in exchange for preferred units in an investment vehicle valued at about $2 billion. That wording matters because Datavault may not simply receive $2 billion of cash. The practical question is how Datavault converts that structure into usable capital. Does it receive cash? Does it receive collateral value? Can it borrow against the preferred units? On what terms? From whom? With what recourse? And what happens if later tranches do not close? The filing says the proposed transaction may represent more than 50% of current outstanding voting capital stock. It also says each tranche closing could give the counterparty 1 additional director nomination right. And upon the final tranche, the counterparty could gain enough voting power to elect a majority of Datavault's board. That is not a footnote. That is control risk. The closing conditions matter too. Due diligence, definitive agreements, stockholder approval, regulatory approvals, antitrust clearance, any required CFI US clearance. Charter amendment if required. Fairness opinion, payment of transaction fees, independent valuation of the preferred units. That is a long list. So the HELMEX story is neither automatically bullish nor automatically fake. It is the first major proof gate. Was the $25 million payment made? If yes, what assets were sold to fund it? Was it Bitcoin, receivables, new cash from the May financing, or something else? Did the payment weaken operating liquidity? Who ultimately controls the relevant HELMEX entities and investment fund? What assets are inside the fixed income vehicle? Who values those assets? What lender will accept those preferred units as collateral? What definitive agreements are signed? What does the shareholder vote look like? What happens to the board? And what does Datavault receive in usable cash, borrowing capacity, or collateral value at each step? That is the real diligence. There has also been public attention around the HELMEX registered office address. The official Companies House page lists HELMEX Global LLP as active, company number OC458827, incorporated November 14, 2025, with first accounts due in August 2027. That is useful registry context. But the address alone is not the whole question. A registered office does not prove financing strength. It also does not disprove financing strength. The stronger question is capital source validation. Who is behind the vehicle? What assets back it? What valuation supports it? What legal approvals are needed? What lender accepts it? And how protected is Datavault if the deal does not close? That is where the serious analysis belongs. Now, if the financing is not cash yet, why does DVLT still matter? Start with the thing that makes DVLT hard. The company does not fit into one clean box. If you call it an AI company, you miss the tokenization and exchange story. If you call it a tokenization company, you miss the acoustic and data capture business. If you call it an infrastructure company, you miss the healthcare, sports, credentialing, and data rights pieces. And if you call it a finance story, you miss the product risk. Datavault describes itself as a provider of data monetization, credentialing, digital engagement, and real-world asset tokenization technologies. That phrase is accurate, but it is not beginner-friendly. So here's the plain English version. Datavault wants to help people and organizations turn data, rights, physical assets, credentials, media, and other assets into things that can be valued, verified, controlled, tokenized, listed, traded, or monetized. That is still a lot. So use one mental model. Imagine you own a valuable asset, but the market does not know how to price it. Maybe it is mineral rights, maybe it is gold, maybe it is copper, maybe it is event data, maybe it is sports rights, maybe it is healthcare data, maybe it is academic credentials, maybe it is media inventory. The first problem is value. What is it worth? The second problem is trust. Can a buyer verify it? The third problem is rights. Who owns it, who can use it, and under what rules? The fourth problem is monetization. Can it be licensed, tokenized, sold, traded, or used to generate revenue? The fifth problem is liquidity. If someone buys exposure, where do they sell it later? Datavault is trying to build pieces across that whole chain. Do not memorize every product name, use 4 buckets. Bucket 1 is data valuation and scoring. That is where names like data value and data score fit. The basic question is, can Datavault help decide what a data asset, physical asset, credential, or right is worth? And can other parties trust that score? Bucket 2 is rights, credentials, and ownership control. That is where Datavault, Datavault Bank, credentialing, and permissioning belong. The basic question is, who owns the asset? Who can use it? And under what rules? Bucket 3 is tokenization and exchange rails. That is where RWA programs, IDE, perpetuals.com, and NYIAX style market structure belong. The basic question is Can the asset become something that trades or generates fees? Bucket 4 is compute, healthcare, cybersecurity, sports, and other optionality. That is where SanQuantum, DevMeds, CyberCatch, ADIO, and NILX belong. The basic question is, can these verticals become real revenue engines, or are they expensive side quests? That is the bull case architecture. It is a data asset operating system. Raw assets come in, they get valued, they get scored, they get permissioned, they get tokenized, they get listed or traded. Datavault gets paid at one or more points in that journey. That could mean setup fees, licensing fees, minting fees, exchange fees, transaction fees, revenue participation, infrastructure fees, or product subscriptions. That sounds powerful, but here's the first trap. A possible fee point is not the same thing as revenue. Do not think of DVLT as one product. Think of it as a company trying to build a toll road for data assets. If assets are valued, verified, tokenized, traded, or monetized, DVLT wants to collect fees somewhere in that process. The proof ladder is how we test whether that toll road is open for traffic. Now look at what has actually reached the financial statements. The Q1 2026 10Q is the anchor. This is where a lot of DVLT conversations go wrong. People jump straight from contract value to market cap, but the filing makes you slow down. Contract value is not the same as revenue. Expected fees are not the same as revenue. Revenue is not the same as cash. Cash is not the same as gross profit, and gross profit is not the same as per share value. Those distinctions sound boring, but they are the entire investment case. If Datavault says a program can generate a fee, that tells you there may be a business opportunity. If Datavault recognizes revenue under GAAP, that tells you a transaction has crossed an accounting threshold. If Datavault collects cash, that tells you the customer or counterparty has actually funded the obligation. If Datavault keeps a strong gross margin, that tells you the model may scale. If that happens without excessive dilution, then common shareholders may benefit. So do not ask only how big is the deal. Ask, where is it in the chain? Opportunity contract, recognized revenue, collected cash, gross profit, per share value for the quarter ended March 31st, 2026. Datavault reported about $3.4 million of total net revenue. The revenue mix was simple. About $2.5 million came from live event production revenue. About $917,000 came from consumer audio products, components, and other revenue. That mix is important because it shows what has already crossed from story into accounting. The reported quarter was not yet dominated by RWA tokenization fees. It was not yet dominated by exchange fees. It was not yet dominated by GPU compute utilization. It was not yet dominated by software like platform revenue. The filing shows a business still early in the transition from product and services activity into the platform model management is describing. Total net revenue was $3.416 million. Cost of revenue was $3.305 million. So gross profit was $111,000. That is about 3% gross margin. This is the financial distance DVLT has to close. $3.4 million of revenue, $111,000 of gross profit, $53.1 million of net loss. That gap is the whole risk. For a company with a platform narrative, that number matters. It does not mean the platform can never work. It does mean the latest reported quarter did not yet look like a high-margin software tokenization exchange or infrastructure business. It looked like a small revenue base with very thin gross profit. Then look below gross profit. Research and development was about $5.7 million. Sales and marketing was about $6.6 million. General and administrative was about $18.7 million. Total operating expenses were about $31.1 million. And the net loss was about $53.1 million. That is the financial proof gap. That means the company had $111,000 of gross profit against more than $31 million of operating expenses. So the issue is not just loss, the issue is distance. The business model has to travel a very long road before it looks like a scalable platform. The reason this matters is not just that losses are bad. Early stage companies can lose money while building something valuable. The real issue is scale and evidence. If a company has small revenue, low gross profit, and very high operating expense, then the next few quarters must explain why those expenses are building a machine rather than just funding complexity. For Datavault, that means investors need evidence that R&D, sales, and marketing and G&A spending are producing measurable commercial outputs. Signed customers, closed acquisitions, recognized tokenization revenue, collected fees, higher margin product mix, repeatable sales motion. Without that, the expense base becomes a clock. With it, the expense base can become investment. The story is large, the current revenue is small, the gross profit is tiny, the losses are large. So when someone says, Trey, DVLT has a huge opportunity, the answer is not automatically no. The better answer is show me the bridge from opportunity to revenue, then from revenue to cash, then from cash to margin, then from margin to per share value. That is the only way to keep the conversation honest. Now look at the balance sheet. At March 31st, 2026, Datavault reported about $2.2 million of cash and cash equivalents. It also reported about $57.1 million of crypto assets. And it reported about $29.5 million of related party receivables. Total current assets were about $106.3 million. Current liabilities were about $23.0 million. The headline current asset number can sound comfortable, but not every current asset is the same. Cash is cash. Bitcoin can be valuable, but it can move in price and has to be sold if the company needs dollars. Related party receivables can be valid, but investors still need collection proof. This matters because the later HELMEX financing disclosure says the source of funds for the first $25 million payment would come from the sale of Bitcoin and receivables. So the balance sheet is not an abstract accounting section. It directly connects to the financing story. Now add the May capital raise. Datavault offered 109,090,910 shares in a registered direct offering at 55 cents per share. Gross proceeds were about $60 million. The company said proceeds would support the quantum-ready GPU edge network, including build-out and equipment, plus working capital and general corporate purposes. That is important. The raise improved runway. It also raised the per-share burden. At March 31st, 2026, the company reported about 617.8 million shares outstanding. The May offering added another 109.1 million shares. And there are additional possible share issuances tied to other transactions. This is where the per share math becomes unavoidable. If Datavault issues stock to buy assets, acquire businesses, fund operations, or complete financing structures, shareholders should not evaluate the company only on total enterprise ambition. They should evaluate what each new share is buying. Is the company issuing stock for cash that funds high return infrastructure? Is it issuing stock for an acquisition with real revenue and customers? Is it issuing stock for collateral or preferred units that can actually unlock usable financing? Or is it issuing stock mainly to keep the story alive while proof remains delayed? Those are very different outcomes. Dilution is not automatically bad if the asset received is more valuable than the ownership given up. But dilution is dangerous when the asset received is hard to value, hard to monetize, or slow to convert into cash. So the shareholder question is not just, can Datavault become bigger? The real question is, can Datavault become more valuable per share after all this issuance? That is where many speculative platform stories get tricky. Total company ambition can go up while each share owns less of the final business. The company has to outrun dilution. Now move to the most visible upside lane, RWA, tokenization. RWA means real-world assets. This is the idea that physical assets or rights can be represented digitally, often through tokenized instruments. Datavault's version includes commodity-linked programs and data asset infrastructure. In the Q1 business update, management said the company had signed more than $800 million of tokenization contracts and expected nearly $100 million of related fees to be recognized in 2026. That is a huge number compared with Q1 revenue. If it turns into clean revenue and cash, it can change the story, but that if is not optional. The company then announced a perpetuals.com agreement on May 29th. The release said the agreement covered more than $328 million in targeted commodity token programs and could generate approximately $38 million in fees for Datavault. It named programs including Gold Vault, Coppercoin, MTB Copper, Triton Geothermal, and American Strategic Minerals. This is more than a generic partnership headline. For tokenization, liquidity is one of the central questions. Tokenization is not the finish line. Liquidity is the finish line. If nobody trades it, nobody values it. If you tokenize an asset but nobody can trade it, the business is limited. If you tokenize an asset but the legal claim is unclear, the business is fragile. If you tokenize an asset but the valuation is not trusted, buyers hesitate. If you tokenize an asset but custody, settlement, redemption, or transfer rules are vague, institutions may stay away. That is why Datavault's RWA story has to prove more than token creation. It has to prove the full market wrapper, asset validation, legal rights, disclosure, counterparty onboarding, venue approval, market making or liquidity, settlement, fee collection, ongoing compliance. If you tokenize an asset and it can trade on a regulated venue with real buyers, sellers, market makers, settlement, and recurring fees, the business can get more interesting. So the perpetuals agreement improves the narrative because it tries to answer the liquidity question, but it does not finish the proof. For RWA, the actual scoreboard is, do the tokens launch? Are the assets independently validated? Are ownership rights clear? Does the venue approve and list the instruments? Is there trading volume? Are the spreads reasonable? Does Datavault recognize fees? Does Datavault collect cash? What gross margin does it keep? And are the fees repeatable? That is the difference between an RWA press release and an RWA business. Now talk about Sand Quantum and the GPU Edge network. This is another part of DVLT that can sound huge very quickly. In April, the company announced that first sites of its quantum-ready, high-performance computing GPU network were live in New York and Philadelphia. It discussed a 48,000 GPU fleet, more than 100 U.S. cities, Q3 2026 commercial availability, and a revenue-generating network by year-end 2026. There is a real market reason this attracts attention. AI compute is scarce. Enterprises want capacity. Secure edge compute can be useful. Post-quantum and zero-trust security language fits the data rights narrative. It also gives Datavault a way to make the platform story feel more complete. If the company wants to manage valuable data, score assets, secure credentials, support tokenization, and handle enterprise workloads, compute infrastructure can become part of the stack. But compute is not an automatic high-margin business. GPU infrastructure can look like AI upside from the outside, but on the inside, it can behave like a capital-intensive utility business. GPU infrastructure can be capital-intensive. It can require power, sites, cooling, networking, security, customer support, hardware procurement, financing, and utilization management. And utilization is everything. A GPU fleet with paying customers can be valuable. A GPU fleet without utilization can become a cost center. But again, the investor translation is not GPU headline equals revenue. The investor translation is who owns the hardware? Who pays Datavault? What is Datavault's obligation? What capital sits on the balance sheet? What does the customer contract look like? What is utilization? What is gross margin after power, site costs, equipment, security, hosting, maintenance, and partner economics? How much of the $60 million offering is being used here? And does the $120 million Silex related funding actually close in usable cash? On the proof ladder, the GPU story is still mostly yellow until utilization, customer contracts, and margin show up in filings. Now bring in NYIAX. Datavault announced a definitive agreement to acquire NYIAX. The strategic logic is clear. If Datavault wants to build data and RWA marketplaces, exchange rails matter. NYIAX gives the story a market structure layer. It is not just we tokenize assets. It becomes we value assets, we score assets, we control rights, we tokenize assets, and we have exchange infrastructure that may help them trade. That makes the product story more coherent. But acquisitions bring their own proof gates. Did the deal close? What was the final consideration? How much stock was issued? What revenue does NYIAX bring? What customer activity exists? How much integration cost is needed? And how quickly can that infrastructure create revenue inside Datavault? CyberCatch is similar. Datavault announced a binding letter of intent to acquire CyberCatch in an all-stock transaction. Cybersecurity and quantum-resistant risk mitigation fit the SAN quantum and data security narrative. But a binding letter of intent is not the same thing as a closed deal, product integration, customer adoption, or margin proof. Deliv Meds AI is another vertical expansion. The Wellgistics announcement ties Datavault's pharmacy chain license to healthcare data, biometric verification, pharmacy delivery, drone logistics IP, and consumer health workflows. Again, there is a possible logic. Healthcare data is valuable. Pharmacy networks have distribution. Biometric verification can matter. But as an investor, you have to ask the same plain questions. Who pays? When do they pay? How much revenue belongs to Datavault? What is the cost to deliver? What is the margin? What share count was used to get there? If the answer is not yet clear, it stays optionality, not base case proof. Now step back and compare DVLT to the proof stock framework. DVLT belongs in the same category as many speculative proof stocks. The story can be real. The market can be real. The technology can be real. But shareholders only win if the proof reaches the financial statements. The business can be ambitious and still unproven. The market can be real and still difficult to monetize. The technology can be interesting and still fail the per share test. That is why the scorecard has to stay mechanical. No matter how impressive a headline sounds, the same scoreboard decides whether it is progress or just possibility. Now put everything together. The bull case for DVLT is not empty. The company is attacking real problems. Data ownership is real. RWA tokenization is real. Credential verification is real. Sports and healthcare data monetization are real. AI compute scarcity is real. Exchange infrastructure can be valuable if Datavault can connect valuation, scoring, rights control, token issuance, exchange liquidity, and secure compute. The model could become much bigger than current revenue. And if Q2 or Q3 filings show tokenization fees, cash collection, better gross margin, closed acquisition progress, and clear financing milestones, the market may start treating DVLT less like an announcement stock and more like an early platform business. And that is the bull case. The bear case is also strong. The latest quarter had $3.4 million of revenue and a $53.1 million net loss. Gross profit was only $111,000. The company has many announced directions at once: tokenization, exchange infrastructure, GPU, edge compute, healthcare, cybersecurity, sports data, credentials, acoustic science, structured financing. That is a lot to execute. And shareholders have to watch dilution. The May offering added over 109 million shares. Other transactions can add more. The HELMEX structure may involve major share issuance and possible control changes. So even if the company gets bigger, common shareholders still have to ask whether each share becomes more valuable. That is the final scoreboard. For DVLT to upgrade, investors need to see Q2 revenue that begins to bridge toward management's 2026 claims, tokenization fees recognized as GIAP revenue, cash collected against contracts, fees, and receivables, gross margin rising well above the Q1 level, product-level revenue disclosure, RWA listings and trading activity, SAN quantum utilization and economics, NYIAX or CyberCatch closing and integration details, HELMEX payment status, and definitive documents, independent valuation and legal support for the structured financing, and share issuance tied to value creating assets, not just runway. For DVLT to downgrade, watch the opposite: more announcements without revenue, more receivables without cash, low gross margin, large operating losses, unclear HELMEX payment status, delayed definitive documents, unfavorable dilution, acquisitions that add complexity without results, and product claims that never show up in the financial statements. The next real catalysts are not more headlines, they are filings. Watch for confirmation of the $25 million HELMEX payment, any amendment or definitive agreement, Q2 revenue and cash collection, tokenization fee recognition, SAN quantum commercial availability updates, NYIAX or CyberCatch closing details, fully diluted share count. Those are the next proof dates. Here's the final view. DVLT is not a finished compounder. It is not a clean software company today. It is not a simple bank, miner, tokenization exchange, healthcare platform, or GPU cloud. It is a very high-risk proof story trying to assemble a data asset platform faster than the market loses patience with the financial proof gap. That can create upside. It can also create serious shareholder risk. The right way to follow DVLT is not to memorize every headline. The right way is to keep every headline on the proof ladder. If Datavault starts proving that chain, the story changes. If it does not, the $2 billion headline remains a headline, not the thesis. That is the difference between a platform story and a platform business. So I am not putting DVLT in the buy box or the sell box. I am putting it in the proof box. The next filings will decide whether this is becoming a platform business or staying an announcement stock. I will track the next DVLT filing using the same proof ladder: headline, binding status, revenue, cash, margin, dilution, per share value.